$1. In just 30 minutes, $7 trillion went. Consider that number carefully for a moment. I want you to. $1. More than Spain's GDP, $7 trillion is a lot of money. It disappeared from the precious metals market in the blink of an eye, despite having a market value more than Mexico's GDP. The price of gold was $5,100 earlier today. At 117, silver reached a new record high, 75. After 3 hours, the price of gold plummeted to $5,000. Falling to $13, silver tumbled. The price of gold fell by 2%. Silver had a 12% decline. I need you to watch this video all the way to the end if you're confused about what just transpired and if you should be scared right now. This crash now makes much more sense to me after seeing what I'm about to show you. This crash was inevitable if you knew where to look, and I'll show you why by pulling up a 30-year chart. What occurred the last time silver's price was this high? I'll show you. Let me tell you, after that, it increased by 462%. However, before I do that, I'll demonstrate the true source of $1. $7 trillion will dissipate in under 90 minutes. Step right into the shadow economy. I dissect the monetary maneuvers that the news media fails to cover. If this video clarifies what occurred, please subscribe and use the like button. Now let's dive in. This morning, something happened that sent shockwaves across every trade floor on the planet. Here is what happened. Around 900 a.m., at the time of writing, silver was selling for 117 CST, $75 for a single ounce. This was the highest price that silver has ever traded at in recorded history, setting a new record. Near record highs, gold was trading at $5,100. There was a clear bullish trend. There was jubilation among all. The price of silver then plummeted from $117 to $103. A loss of $14 or 12% in less than 2 hours occurred during the span of 90 minutes. Price of gold fell from $5,100 to almost $5,000, a $100 decrease of around 2%. The exciting part begins now. After a 2% decline in gold, silver fell 12%. Very same market, very same time period. Differing responses entirely. Why? To fully grasp what I'm going to tell you, you must ask that question. Let me preface this by saying, I have something to tell you that will alter your perspective on price charts forever, and it has to do with the cause of this crash. I guarantee that by the time you reach the conclusion of this section, you will have no trouble understanding it, regardless of your level of familiarity with charts. There are two main things that traders search for when they examine charts, arguments for and against. Consider it in this way. Picture yourself as a bouncing ball on a room's floor. A solid base is the floor. The ball always manages to bounce back up after hitting the floor. Resistance is the ceiling. The ball always comes tumbling back down after hitting the ceiling. At a price point where buyers are active, we have support in the market. They always comment, "That is cheap. I want to buy," if the price falls to that level. In addition, the price goes back up due to the buying demand. Opposite this is resistance. At this pricing point, vendors start to pop up. "That is expensive. I want to sell." When the price reaches that point, people always start selling, which causes it to fall again. Now I'll show you a 30-year chart that, when I finally put the pieces together, left me speechless. Silver followed what is known as a descending channel in its trading from 1996 to 2014. Think of the price as bouncing between two diagonal lines running down the middle, as if it were a ball between two walls. Throughout those 18 years, a single line ran down the center of the channel, serving as a crucial level. This is going to be referred to as the white line. Silver fell so low in 2008 that it touched this white line, all because of the financial crisis. Silver was selling for $8 right then. $8. What happened next is important for you to note. When silver touched the white line in 2008, it did more than just bounce. From $8 in 2008, it skyrocketed. In 2011, silver reached a high of $45 per ounce. In just over 2.5 years, that's a 462% increase. The white line represented support. There was a strong bounce as the ball struck the floor. Now let's go on to the present day. There has been a new upward channel in silver's price from 2014 to 2026. See two diagonals rising from the bottom to the top. But you know what? Occurred recently. The identical white line was touched by silver once more. Just the same level that provided support in 2008. The key distinction, however, lies in this point. When silver hit the line in 2008, it was falling. Serving as a foundation, the line was the ground. The year 2026 was a bottom-up entry year for silver. The ceiling, or resistance, is now the line. The floor turned into the ceiling. Furthermore, what happens when a rapidly moving ball collides with the ceiling? It falls back down with force. That is precisely what transpired earlier today. A 30-year trend line, which has marked significant market turning points over the past 30 years, was broken by silver. Because the amount is so high, the rejection was really forceful. That wasn't an accident. I did not manipulate you in any way. An unexpected occurrence did not occur. In response to a significant multi-dead resistance level, this was the classic technical reaction. This explains why silver fell 12% while gold fell only 2%. Earlier today, gold avoided all significant historical resistance levels. The broad sell-off in precious metals has just caught me. However, silver crossed a crucial threshold that has shaped this market for the past 3 decades. Sure, you might be thinking that silver dropped when it hit resistance. Does that signal the end of the market's bull run? Should I liquidate my possessions? Take your time. After silver crossed that white line in 2008, I'll tell you what happened. Let us not forget that in 2008, silver crossed the $8 mark. The subsequent 2.5 years saw a 462% increase, taking it to $45. However, the majority of individuals fail to remember this thing. No, silver did not immediately move smoothly from 8 to 45 degrees. Along the journey, there were crashes, shakeouts that led investors to believe the bull market had ended, precipitated by violent 30% to 40% declines. The general tendency, however, was upward. What else is there? Silver continued its ascent in 2011 after finally overcoming the obstacle of the white line. And thus, the central question arises. Have we experienced the silver's bull market coming to a close? Or is this simply the market correcting itself as it is part of a wider upswing, a consolidation period before the subsequent upward leg? I will present the arguments for and against each side so that you can make an informed decision. This aspect is vital, so let me explain the second reason silver collapsed 12%, while gold dropped only 2%. Most futures trade in gold and silver on the COMEX exchange, which is administered by the CME Group. The precious metals market has traditionally used this as a signal for significant turning points. They increase the margin call. In the simplest terms I can think of, let me clarify what that means. You are not required to risk the entire purchase price while trading futures. Margin is the tiny proportion you put up as security. It functions similarly to a deposit. Assuming the price of silver is with an ounce of silver costing $100 and a futures contract encompassing 5,000 ounces, the total value of that contract is $500,000. However, $500,000 is not necessary to trade it. Your margin requirement may be as little as $20,000. All of $500,000 are under the grip of those $20,000. Leverage describes that. What occurs when the exchange increases margin requirements is as follows. What was once a $20,000 or $30,000 trade now necessitates $25,000. $32,500, precisely the same amount that CME transacted last week. The margins for silver are increased by 47%. Prices range from approximately $22,000 to $30,500 USD each contract. There is now an issue for fully leveraged traders. Either you need to withdraw more money from your account right away, or you need to sell some of your investments. The majority of traders are unable to quickly add funds. They have no choice but to sell. The question is, how does the price react when thousands of traders are compelled to sell simultaneously? It gives out. A liquidation cascade describes this phenomenon. Forced selling triggers. As prices fall and more margin calls are triggered, there will be more forced selling. As a mechanical trigger, the CME margin rise was used. Crash is today. The 3-decade I was triggered by the resistance line. When you combine the two, you get a 12% drop in that time frame. For those who are short silver, this is the section that should make you very concerned. For those who are hoping to purchase the dip, it should make you quite excited. Every single big silver top in the contemporary era has followed this precise playbook. Nelson and William Hunt, 2 brothers, had amassed enormous silver holdings by 1982. Within a year, the price of silver jumped from $6 to $50. Then, in an effort to severely limit margin buying, the COMEX introduced Silver Rule 7. Within a few short weeks, silver's price plummeted from $50 to $10. In 2011, the Hunt brothers declared bankruptcy. Price range for silver was $8 to about $50. A total of 5 times during a span of 9 days, the CME increased the margin requirements. Shortly after its 50-week high, silver plummeted to below $30. Now fast forward to 2026, and silver prices ranged from $30 to $107. Profits increased by 47% at CME. An hour later, silver had fallen 12%. The same playbook, but a previous era. What comes up after this? This is because there is one topic about which no one is speaking. A 20-year barren market for silver followed the 1980 crisis. The end came with that crash. However, silver's price fell from $50 to less than $15 in the years following the 2011 meltdown. But the bull market has returned, and silver is currently selling for more than $100. So the disaster of 2011 was just the beginning. Within a broader secular bull market, there was a downturn. Can you tell me what kind of crash this is? Allow me to present the proof, and then you can choose for yourself. Start with the negative scenario. Reasons why this collapse could be a precursor to a more serious problem. Within a year, the price of silver increased 270%. By any measure, that is a completely stupid decision. Such a parabolic motion usually backfires. The ratio of gold to silver has shrunk significantly. At the time when pushed to its limits, this ratio frequently reverts abruptly. There is a great deal of speculation. On one side of the trade, everyone is. The trade typically turns around at that point. The positive case, the reasons this crash can be a buying opportunity. The basic supply and demand picture has not altered at all. China still limited silver exports on January 1st, and margin rises historically marked tops from 1980 to 2011 and now 2026. That continues to have an impact on 60-70% of the world's silver supply. The inventory of registered silver available for delivery has dropped from 86 to 28 million ounces, a 70% decrease from its high. It remains the same. Industrial demand continues to skyrocket. Solar panels consume an increasing 200 million ounces annually. Silver is essential for EVs. Gold is essential for AI data centers. 5G networks need silver. That remained unchanged this morning. There has never been a structural supply gap like it. The demand has outpaced the supply for 5 years in a row. A total of 820,000 ounces are in limited supply. Everything remained the same. There is still a premium of $6 to $9 above the paper price of silver in Shanghai when buying physical. Once the bull market ended, the premium would plummet. Not at all. This brings us to our first and foremost point. The fundamentals were weaker when silver crossed the $8 mark in 2008. An embargo on exports to China did not exist. In the solar panel boom, there was none. The EV revolution did not occur. Building out the AI infrastructure did not occur. At this point in time, the fundamentals of the silver market are among the greatest that they have ever been. The crash was caused by the technical setup nevertheless. You must comprehend this strain. Even when fundamentals scream bullish, technical considerations can nevertheless create short-term crashes. In the end, it all comes down to whether the fundamentals will prevail over the technicals or the other way around. Succumb to the intricacies. In the long run, basics always come out on top. However, in the near run, technical issues might cause a lot of suffering. What happened in the physical market today is something that very few people are talking about, so allow me to fill you in. You guessed it. Physical silver premiums went up while the paper price fell 12%. The 12% price cut was not implemented by the dealers. Almost nothing was being done to lower them. Demand surged as bargain hunters attempted to purchase the dip, leading some to actually increase premiums. This pattern repeated again in 2022's nickel market. Nickel was selling for $20,000 on paper. Later on, physical supplies became limited. After a few days of playing catch-up with physical, the paper market caused prices to skyrocket to above $100,000. The truth. Wondering if it would work with silver as well? Truthfully, no one can say. The fact that actual premiums are different from paper pricing, however, indicates that something is amiss with this market. Each ounce of actual silver stored in Conch's vaults carries 356 paper claims. You read that correctly. The ratio of 356 to 1. It would be the same as if every seat on the plane were sold 356 tickets. The mathematics eventually gives way. In light of what we have just seen, allow me to provide you with some context. One of the biggest intraday movements in silver market history was a 12% decline in 90 minutes. September 2020 was the last time silver had such a dramatic price change. That can't happen unless you return to March 2020 when the stock market crashed. I was in 2011 before that. Such a change occurs seldom, perhaps once every 10 years. Moreover, I would like you to observe the following pattern. In each of the last 15 years, silver has rebounded from similar crashes to reach new highs, recovered from the September 2020 crash, and achieved new heights. In March 2020, there was a COVID-19 crash. Nonetheless, the company recovered and achieved new heights. It took years after the 2011 meltdown for prices to rebound, but they have already reached all-time highs in trade. When they occur, the crashes seem catastrophic, but when you look nevertheless, they were really temporary setbacks amid a broader upswing in the market. Is this going to be an exception? Could be, but past results indicate it's more likely not. I must now make one thing crystal clear. That's not my job description. There is no financial advice in this video. The price of silver fluctuates wildly. As we have just seen, we can definitely drop the price further. Know that margin hikes can ruin your silver investment if you're leveraged. Being correct regarding the long-term direction is of no consequence if you are liquidated before the trade is executed. Be aware that catching a falling knife might be quite uncomfortable if you are thinking about purchasing this dip. It is possible that a decline will occur before an increase. Conduct independent research. Learn how much you can handle risk. It is up to you to decide. My analysis leads me to believe that the 30-year resistance level and subsequent margin rises were the technical and mechanical triggers for this disaster. There has been no change to the basic picture. Chinese export restrictions persist. Persistent shortages in supply continue. However, demand from the industrial sector continues to rise. There are still physical premiums, insightful points. In order to ascertain if this is a buying opportunity or the beginning of something worse, I will now tell you what I am personally observing. I am keeping an eye on the $100 level first. It would be quite optimistic for silver prices if they can consolidate and maintain a price over $100. This would imply that the accident was a correction rather than a change in trend. Silver has already recovered from its recent low of 103 and is now trading at about 109 as I film this video. Although it's encouraging, we need to see it continue. Additionally, I am keeping an eye on physical premiums. A decline in physical premiums would be a negative development. This would indicate that actual demand is declining. Up until now, premiums have remained stable or even gone up. Positive outlook. And finally, I'm keeping an eye on the COMEX inventory. A bearish indicator would be an increase in inventory levels. The tightening of supplies could be indicated by this. So far, stock is still going down. Positive outlook. And lastly, I am keeping an eye on China. It would be unfavorable if China were to lift its export prohibitions. Nothing has happened to indicate such as of yet. Positive outlook. Lastly, I am keeping an eye on the CME. It would be unsettling if margins were to be raised once more. Prepare for additional forced liquidation. Their announcements must be carefully watched. Currently, 4 of the 5 indicators point to a bullish market. One unfavorable aspect is the possibility of a margin hike. The suffering, however, will continue. The duration that markets remain crazy can exceed. You'll be able to survive financially. Watch out. First, something that I believe is really crucial to keep in mind is the big picture of history. When the price of silver fell from $50 to $10 in 1980, many believed that precious metals had died. It was the end of the bull market. There would be no resurgence for gold and silver. Gold is now at $5,000, 45 years after it was first priced. Gold is trading at around $1,000. Those who claimed it was over were utterly mistaken. The drama unfolded over decades. When silver's price plummeted from $50 to less than $15 in 2011, everyone had the same opinion. Dead precious metals. Market gains have peaked. We are already reaching record highs, 15 years after we started. When you're in the middle of the crash, it feels like the world is ending. But when you step back, you'll see that it's only a small correction embedded in a much bigger narrative. The bigger picture is this. The world's debt burden has never been higher. The U.S. alone has $38 trillion. There is no practical way to repay that obligation. Just blowing it up will do the trick. The role of central banks involves creating new currency at dizzying speeds. Reserve management purchases will cost the Federal Reserve $45 billion per month, as reported recently. Just this year, it amounts to $540 billion. The need for silver in industry is both structural and increasing. These tendencies, solar power, electric vehicles, artificial intelligence, and 5G, will not fade. We are unable to answer promptly due to limited supply. Another mining process yields 75% of the silver. It takes 10 years to establish a new mine. A 12% price cut has not altered these underlying drivers. They seem to be strengthening, if anything. Right now, I want to address 3 distinct demographics that could be seeing this video. The first category includes those who sold out of fear this morning. You recorded the impact. Your account was found to be declining. A chill ran down your spine as you sold. You may be sure that I will not inform you that you are mistaken. Perhaps you did, perhaps you did not. Everything will be revealed in due course. Still, I must share this with you. When making emotional decisions in unpredictable markets, it's practically inevitable that what feels right at the time will appear wrong looking back. You should give serious consideration to your motivations if you sold without doing any research because you were afraid, opted to do so. The second category includes those who are considering purchasing this dip. You saw the catastrophe as a chance for growth. Entry points are improved when prices are lower. Buying the dips during bull markets has historically yielded high profits, but jumping on the bandwagon too soon during a correction can lead to significant losses. This is a potential consolidation point, or silver might fall further lower. Have patience. Step back. You shouldn't put all your eggs in one basket of prices. The third category includes those who are on the outside looking in, not sure if this is their moment to jump in, and who have no position. You know what? When the headlines are screaming crash and everyone is freaking out, that's when it's best to purchase. In the past, the most favorable circumstances have arisen at that time. But belief grounded in evidence, rather than relying solely on intuition, is required. Make a well-informed choice after you've studied the basics and mastered the technicals. How are things going for you? Leave it in the space provided. Every single one was read by me. My last reflection on this momentous occasion is this. The collision happened. 12% of the time is aggressive, even though it is painful. Naked markets do not experience crashes. Overheated bull markets need a reset, and when that happens, crashes occur. If silver fell from 117, then it must have gotten to 117 somewhere. The price was $30 a year ago. Even though the day was bad, the trend is still positive. The increases in the margins are worrisome. Not only have they indicated peaks in the past, but they have also denoted interim fixes on prior occasions. For the next few weeks or months, we have no idea which one it is. There is an actual 30-year resistance line. Silver was rejected after reaching a substantial technical level. Yet in the past, silver has gone parabolic after breaking through significant resistance levels. Everything else remains the same. Chinese regulations, shortages in supplies, demand in the industrial sector, physical premiums, steadfastly optimistic. To sum up, this is my verdict. A structural crash occurred. If one knew where to look, it was predictable. Technical resistance and mechanical liquidation were the culprits. However, opportunities, not doomsdays, lurk in structural breakdowns that occur within bull markets. I will not be selling, I'm not freaking out. I am observing. Please wait. I am also getting ready. If silver finally breaks past that 30-year resistance level, the subsequent move might make the previous 12 months seem like a warm-up. After all, history rhymes. It was in 2008 that silver crossed that $8 mark. A 462% increase later, it hit 45. Silver crossed that level at 117 today. It recovered to 103 again. This time it's back up around 109. Where does silver go if it breaks through that resistance? It is up to you to complete the math. Leave a comment with a like and a thank you. Every comment is read and I want to know what you think, whether this video helped you understand what happened today. Give this to someone who was freaking out because of this. Good morning. Before making a hasty, regrettable judgment, people should see this analysis. Get in on the action before anybody else by subscribing. If you want to know what the mainstream media misses every week, I have a video for you. A thud sounded. It was a very violent crash. However, this is just the beginning, by a wide margin. Next time, I'll see you. Do your best in the field. Just one last thing before you leave. I feel compelled to bring up the topic that has been completely ignored, the elephant in the room. There will be commenters who accuse manipulation of this crash. The major banks plan this to frighten off individual investors, that short sellers are about to be squeezed, and the CME hiked margins to protect them. Here is my sincere opinion on the matter. Can it be done? Yes. Can we prove it? No. Our certainty lies in the following. A recent revelation indicated that JP Morgan's unrealized losses on silver amount to roughly $5 billion positions. In addition, they allegedly went from having a huge short position to actually owning almost 750 million ounces of silver. The CME increased margins by 47% just as silver was about to hit significant technical resistance. Curious about the timing? You have my word for it. Now let me tell you something about markets. This crash's significance is moot. Either manipulated prices or prices moved naturally. Both outcomes are identical. A decline was observed in the prices. The impact of the liquidation of leverage traders now needs to be addressed. Angry outbursts about possible manipulation are a waste of energy. One must be familiar with the structure of the market and position themselves appropriately. Therefore, pay attention to the things over which you have some measure of influence. Scale of your position, method of risk mitigation, and approach to entering and leaving the market. Do not allow yourself to be paralyzed by conspiracy theories. Instead, let them entertain you. Finally, I have some information that I think is really important to share with you. Is the fate of silver known to you after each of the 50-plus CME margin hikes? After the margin increases in 1980, silver's price plummeted from $50 to $10. However, it recovered enough to reach 50 and beyond in the decades that followed. After 2011's margin rises, silver's price plummeted from $50 to $15. The following 15 years, however, saw it rise to over 100. Despite the fact that the margin boost hurt in the short term, the long-term bull case continued in every single instance. Why? Increases in the margin combat speculation, and so do not. Get down to the basics. Increase margins as much as you desire. Physical silver cannot be printed. Demand in the industrial sector cannot be magically generated. Raising margins won't help you get over China's export limits. The increase in the margin is more like a speed bump than a wall. So, once the forced liquidation is complete and the weaklings have been removed, you never know. What remains? Those with strong hands, patient capital, and a long-term perspective can weather the inevitable volatility that comes with massive gains. Your persistence has likely earned you the title of strong hand if you have reached this point in the film. You remained composed. You didn't immediately turn off the video when bad news started to roll in. You lingered so you could grasp the big picture. Having that mindset will benefit you in all aspects of life, not only with precious metals. The very nature of markets makes it possible for the leveraged to lose money to the unleveraged, the emotional to gain it, and the impatient to gain it. Stay on the correct side of that switch. $1 today, 7 trillion disappeared. It remained nevertheless. It passed on from one group of people to another. It is important that you take turns receiving and not giving. That's the whole point. You have learned the rules now. Adapt your playstyle appropriately. If you found this helpful, please share your thoughts in the comments. Sign up for the channel if you're interested in showing your support. Looking forward to seeing you at the following.